Okay, let's get into this week's weekly economic and market update. And really, today, Friday, the 6th, October 6th, was turns out to be a very important day, at least for the time being. There will be other moments of truth upcoming in the markets, but let's start with the SPX, and we'll look at kind of what happened today. And this is the weekly chart. Let me go to the daily real quick. We've been hanging out this week for the S&P 500 index way down here. What did it get? 1645. But this 4200 level is so important. People have been talking about it now for weeks, that if this thing breaks 4200, all types of algorithmic trades would happen. There'd be a lot of selling going on. So I was prepped going into this morning that if it broke through here, I'd at least start buying puts, small, and then kind of scale in to see if it held. Well, this morning, go to the economic calendar here real quick. We got the non-farm payrolls. And the non-farm payrolls came at 336,000, which was way more than what the consensus was, almost double what was supposed to be there. And the unemployment rate stayed at 3.8%. And when that came out, the market tanked. Ultimately, it started way down, and you can just see from the SPX, here we go. We're down here. And, during the day, well, it opened here around 42.34, made its way down to, 42.19, not quite as low as it was on Tuesday, but it was low enough that I started to warm up my puts, for relief pitching, anticipating there could be something big happening here. And it just completely reversed. I'm going to say around 9, I started, 9? Yeah, it was probably more closer to 10. I wanted to wait for some of the chaos to happen first. I didn't buy at the bottom here, but definitely as it made its way up, like I said, it opened here, went down. So somewhere probably right around in here, the Qs, the Dow Jones, I was involved with in buying as it started making, because I figured, well, if it does go to 4,200, I'm going to, I'll sell and start buying puts. But we're so close to the line, we'll see what happens. And so, I had everything all queued up, ready to go, and it did. It started to make its way. I'd never bought any puts because even though as close as it got, it never got to 4,200 or under 4,200. So, at least for now. And as people started looking at the employment report, the non-farm payrolls, really full-time jobs fell 22,000. And there were people taking over 120,000 people that were taking second jobs. So that doesn't spell for a very good economy. I don't know if that's what drove this up, but it had been oversold. The markets have been oversold for a while. So that's a look at kind of what caused a little bit of excitement today and some anxiety and many other things. And, I have my big red line down here ready for it to get crossed. Now we go to other parts of the market. The Dow Jones, really, we look at for the week, We had this Head and Shoulders thing here and we broke this neckline here, thought we were off to the races, and then, had other plans. Now, the interesting part is the Head and Shoulders has a pretty high percentage rate, according to some of the statistics that I've seen. Once it breaks here, about an 84% chance, somewhere around, it was, over 80% chance of that you're going to wind up going up from there, but it didn't happen. So, we've come back down, and on the Dow Jones, bottomed here, made its way up. So it's recovering, but not until we really go past this neckline again around 34,325, or 34,314. Well, that's not right. That number's off. I don't know why it's not reading correctly, but at basically 34,400. Why does that say 407? That number's not right. Anyway, we got to make our way up to this neckline in order for things to get back on track here, and we've got a ways to go. I'm just going to do a refresh on this and see what happens here. Oh, excuse me, 33,407. My number's 34,314 that we need to get to. So we're still, 900 points on the Dow below where that neckline was. Sorry about that. We look also at the Qs. We've had this triangle or this banner kind of forming. We haven't broken. We tried to break out last week. We tried to break out this week, but still wound up in there. So we'll have to see which way this thing breaks ultimately, whether it winds up breaking down or breaks up. And then the Russell had, it's been in this box here, and I would just kind of take a look at it since April of last year is when it started, right around in here. And these are weekly data also, but we've been stuck basically in this 163 to 198, 199 box since that time period. Now that's a big range, obviously, that you could potentially trade in. But when it started to break down, it's still got a ways to go in order to get down here. Well, we were in the 160s though, before we had kind of a recovery for this week, and you can tell on today was really, we got the big candle there. We still have this at 179.89. We still have a gap to fill. So we're still far away from all-time high here of 244.32, and this is an indicator of the breadth. We go down here and we're not getting the breadth in the market yet that you would want to see if things were going to continue to go up. So we'll keep track of this and see how we're performing. But we obviously we had a kind of cross current of things. Interest rates went up based upon some of these data on the 10-year yield, and it topped out, what is this, about 4.887%, and then made its way back down today, but really went up there, and we really want to get it under this, at least for starters, get it under this 4.338 or this uptrend line, which probably isn't even valid anymore. It may have to be something like, what could we draw here? I'm not even sure this one's valid. It's getting too far away too. So anyway, we've got a ways to go for at least on the 10-year for it to recover. And, you know, if we look at the dollar, it's starting to, you know, last 3 days anyway, we've been down. And then for the week, our first down print in 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks of straight up on the dollar. That is a topping tail, breaks here, then maybe we're on our way back down on the dollar. One bright spot for everybody that cares is look at this candle on Crude, the weekly candle. You know, we kind of hung out, had a couple doji weeks here, and then the collapse this week. So we're back into, you know, the low 80s on crude oil. See if this thing continues its way down, kind of levels off. But the fact we've broken this trend is a welcome relief for many people. And I'm sure, you know, we look at what's going on. We have, you know, Peter Schiff would be expecting these things to continue on up. David Hunter's been calling for this thing to break, that it's been topping, but he also believes that, yeah, dollar might, but we still got to see a little bit more evidence of what's going on. And the 10-year yield is still, which is surprising that, you know, the markets went up, but this is expectation that the Fed will raise the federal funds rate again. So that's a pretty good look. You can also look at the VIX, the volatility index, and, you know, it spiked up this morning, up over 20 for the first time in a while since May of this year, and wound up down for the day, you know, by a point, a little over a point. So that's the weekly data. Let's go back to the economic calendar and fill in the gaps of things that you know, happened this week. We did have the S&P Global Manufacturing Index came in a little bit better than expected, and I think this kind of started some of the negativity in the market, and because things are a little stronger than people are expecting them to be. 47.8 on manufacturing PMI was the actual, came in at 49. The JOLTS really got people negative on Tuesday with expectation of 8.8 million job openings, came in at 9.61. Wednesday, we had mortgage rates go up, which, you know, these are things that are going to be headwinds for everything, products and, you know, buying TVs and washers and dryers and all the stuff that you need, and furniture that you need in a new house. The PMI came in pretty much in line for the composite, which is services and manufacturing together. And then global services PMI came in pretty much in line, a little lower. So, you know, there was a lot of movement on that. ISM services came in line with the consensus. And let's see, what else did we have here? Really, there was initial jobless came pretty much a little bit under, but really didn't affect much. But when the non-farm payrolls was kind of the thing that moved the markets today, the market was oversold. So there was an expectation that things would go up. And I think once people started tearing apart the numbers of the non-farm payrolls and saw that really full-time employment fell by 22,000, it kind of changed the attitude of the market, and, you know, thinking, okay, the Fed is not going to do anything. Next week is going to be an important week. Really nothing Monday and Tuesday, but Wednesday you're going to get the PPI, obviously mortgage rate too, but the PPI will be big. You know, 0.3% on the PPI is expected. Core PPI at 0.2, and it's been coming in pretty much, on point with regards to what the consensus is. FOMC minutes will be released at 2 o'clock on Wednesday. That could have an effect, especially if they say something like, well, we're going to raise in our next meeting. Thursday, we have CPI, the core inflation rate. These are all big market movers. Initial jobless claims have been pretty quiet so far. And then Friday, we had the Michigan consumer sentiment, which was 68.1, expected to drop a little bit. And that's pretty much it for the economic calendar for this week and for next week. The other things I wanted to cover, keep on tracking this Truflation number. You're starting to see food back off a little bit versus, a week ago, the 2.46%, and the government's reporting 3.7%. And housing up a little bit, transport down primarily because of oil, at least my belief, although it usually takes a while for it to really show up in the numbers. Utilities are down, and those are kind of the big ones anyway. So we'll see. We'll keep an eye on what this number is reporting. Had it as high as 9.7%, but you can see the numbers here. The other thing I wanted to cover was the Fear and Greed Index. Now, interestingly enough, it shouldn't be surprising. It might be something that helps people. Not necessarily recommendation, but look at the extreme fear that happened. This happened in October 14th, which is when the market started to turn around last year. And then we had another extreme fear here of 23 on March, which was another point where things started to turn around. And here we are again, all the way down to, it was, if I can get it to stay, 18. I think it got as low as 16, but probably didn't close there. 18, and here we are on our way back up. So is this the start then again of another rally up, and will take us to all-time highs? And I think if you look at the SPX, for instance, the S&P 500 index, we are 6.5% from where we are right now to all-time highs, and or 280 points. Now we did 50 today. If we start knocking off 50 at a time here, then we're looking pretty good. My final comment, and I wanted to kind of, I talked about this when I first started this channel, and technical analysis runs things right now, but we've been in an environment for a long period of time, since the great financial crisis, where the Fed started quantitative easing and putting more money into the economy, and to get us out of the great financial crisis. And I'm kind of with Peter Schiff in that they should have let it collapse, and we would have been over it then. Now we've just made a bigger mess over a period of time. But the quantitative easing and the lowering of interest rates now has created a situation where technical analysis rules, because nobody cared. It's kind of like back in the internet fiasco at in 2000. Everybody was buying .com, whatever. It's how Mark Cuban made his money, and created quite a hysteria around anything internet, anything .com basically got bought up, and the irrational exuberance was what Greenspan called it. And so it continued up, and what it's done is and I'm not going to say it's completely negated, because some of the best investors are people like Ray Dalio and Warren Buffett still, that look and take time to read financials and go through and what companies are actually of value. And this is, we haven't hit it yet, because you can use technical analysis if it's all going up all the time, right? So this is the reason for the channel Brains and Bulls, and the saying, don't confuse brains with the bull market. And everybody can do well when interest rates are low and quantitative easing is going on, and you can just watch the charts go up. But that's coming to an end, and a lot of these companies, I'd be paying attention to their balance sheets and income statements. Learn to read that, and I'll have some things on here upcoming. I used to invest this way back before the dot-com bust, but with all the hysteria, associated with the dot-com bust, nobody cared about the fundamentals. Just if it's .com, buy it and it'll go up. And you have some of that kind of thinking that was going on in 2021, late 2021, when things were really raising before we went into a bear market. So it's going to be important to keep an eye on, these balance sheets and income statements. There are companies out there, and this is just my opinion. This is nothing necessarily to trade off of, or even listen to my stupid advice. But, DoorDash, Airbnb, all these companies. Now, Airbnb, I think, makes money. I don't know that DoorDash has ever made money. We have to look, but you're going to have to start looking for those companies, and we'll start to talk about in a recession the types of companies like, hospitality and leisure, where all the jobs are coming from right now. In a recession, don't do well. So we're going to need to be able to, and I hope to, on this channel, at least take this time or possibly another episode, take time to talk about different sectors that in the past, at least, have not done well in a recessionary period. But right now, if David Hunter's melt up happens, and we do have crude oil down, we don't have the interest rates, we're starting to get a little bit of a reaction from the DXY or the Dixie, the dollar. If that starts to go down, you're going to start to see the market go up. And so I think it all ends the same way, whether it's David Hunter or Peter Schiff, it's all going to go to hell in a handbasket, and you're going to have to actually be an investor again. You're not going to be able to just look at charts like I show every week and say, oh, look, it's going up again, type of thing. I'm not completely discounting technical analysis. I won't do that because I think there's some value associated with it, but there will be more value associated with companies that actually have strong balance sheets, strong income statements, and the ones that don't are going to have a heck of a time. And especially if these interest rates continue to go up, as Peter Schiff thinks they will, you start hitting 5% on the 10-year. This affects banks. This affects a number of things, and so you're going to have to be a smarter investor at a minimum, and be able to navigate the upcoming markets. Anyway, that's what I wanted to cover this week. And remember, there is always a better way.